Hello everyone. So in the previous video we covered responsibility centers and responsibility accounting for different levels of centers. And we talked about the cost centers, the profit centers, and now it's time to talk about the investment centers. So what's already covered in the profit centers is already included in the investment centers, but we actually add to it the investment in assets. So an investment center manager has the responsibility and the authority to make decisions that affect not only cost and revenues, but also the assets investment or the assets invested in the center. So because investment center managers have responsibility for revenues and expenses, operating income is part of the investment center reporting. So in addition, because the manager has responsibility for the assets invested in the center, the following two additional measures of performance are used. So one is called return on investment and the other is residual income. So I'm sure all of you heard about return on investment in financial accounting. So I hope you still remember that, because that would be handy once we start the discussion about the return on investment. So I hope you can remember the calculations. So to understand this more, let's use this example. So the condensed division income statement for the Northern, Center, and Southern division of Data Link Incorporated, a cellular phone company, would be seen in the following exhibit. So exhibit 6 here shows the divisional income statements for this company called Data Link, which they have three divisions. One is the Northern division, the other is Central, and the third one is Southern. So they have their revenues, and you can see that the Southern division has the highest revenue. Operating expenses also is subtracted from the revenues to get the operating income before the support department allocations. And you can see here the Northern division has the highest operating income before the support department allocations, because they have the lowest operating expenses. Then we subtract the support department allocations, and here we go back and see that the Central division is the one that has the highest operating income. So let's try to refresh our memory a little bit with return on investment. So because investment center managers control the amount of assets invested in their centers, they should be evaluated based on the use of these assets. So the return on investment is actually how much income or how much you're able to generate out of the assets invested. So one measure that considers the amount of assets invested is the return on investment, or we know it as ROI. So how we calculate the ROI? It's the operating income, which is this bottom number, divided by the invested assets. The higher the return on investment, the better the division is using its assets to generate income. So the return on investment measures the income or the return on each dollar invested in the form of assets, and as a result, the return on investment can be used as a common basis for comparing divisions with each other. So if we go to our example here for Data Link, they have these three divisions, the Northern, the Central, and the Southern. And you can see that these are the invested assets. So if we want to calculate the return on investment for each one of these divisions, we get the operating income from the previous chart here, or Exhibit 6. So we have the 70, the 84, and the 75. And we divide these three numbers by the related invested assets. So that would give us percentages, because 70 divided by 350, that's going to be 0.2, or in other words, if we multiply by 100% or by 100, that would be 20%. So you can see here that the Northern division has the highest return on investment. The Central division has the lowest, which is about 12%, and Southern division is in the middle, 15%. So to analyze differences in the return on investments across divisions, we can use something called the DuPont formula. This is actually used in many cases, and the DuPont formula is actually a breakdown of the return on investment. So we have already one ratio, we split it into two ratios. These two ratios are the profit margin and the investment turnover. So the product of these two ratios is the return on investment. So I'll try to explain that to you. So the return on investment is actually the product or the multiplication of the profit margin and the investment turnover. And this formula is known as the DuPont formula. The DuPont formula, I think it goes back to the person who put it together. And again, we're trying to break down the return on investment into two other ratios. One is the profit margin and the other one is the investment turnover. And when we break it down, we get a better analysis of the return on investment. We understand what was the reason for the return on investment. Is it the higher profit margin or is it the higher investment turnover? So remember, the profit margin is calculated as the operating income divided by the company's sales. And the investment turnover is actually the ratio of sales divided by invested assets. So when we multiply these two ratios together, see here that sales can cancel the sales in the other ratio. So that would be the return on investment, which is basically operating income divided by invested assets, which is the ratio that we've been using before, operating income divided by invested assets. But again, when we do that, we have a better analysis. We're breaking down the return on investment ratio into two other ratios, which is the profit margin and the investment turnover. So the return on investment, profit margin, and investment turnover operate in relationship to one another. So if we try to analyze the three divisions, the northern, central, or southern, so we can see that we have the return on investment can be broken into these two ratios. We have the operating income, the first ratio, which is the profit margin, which is calculated as operating income divided by sales, and then the investment turnover, which is the sales divided by invested assets. So we run the numbers, we get here 12.5 for the northern division, that's the profit margin. The central division profit margin is 12.5 also, and the southern division is only 10%. For the investment turnover, it's 1.6 for the northern division, 0.96 for the central division, and 1.45 for the southern division. We multiply these two values together, we get the return on investment, which is the 20%, 12%, and the 15%. Same values that we had before here. Alright, so I think this is good because you can now know how these ratios, if we break it down to profit and turnover, or profit margin and turnover, then we get a better understanding of what's going on among the three divisions. So to increase the return on investment, the profit margin and the investment turnover for a division may be analyzed. So it's a form of analyzing your return on investment. So assume that Northern Division is a highly competitive industry in which the profit margin cannot be easily increased. And the division manager might focus on increasing the investment turnover. So assume that the revenues of the Northern Division could be increased by $56,000 through increasing operating expenses such as advertising. And that would make it reach $385,000. So if we look at the numbers now, the revenues is $560,000 plus $56,000 that we are able to increase in the revenues. So that would make it $616. Our operating expenses is $385 based on the increase of advertising. So that would give us an operating income before support department allocation to be $231, and then we have the support department allocation of $154,000. That would give us an operating income of $77,000. So if we do the analysis for the return on investment, you can see that we have 12.5%, that's our profit margin, and here we have the 1.76, which is the investment turnover, and that would increase the return on investment to 22. Remember, it used to be 20. So the profit margin is still the same, but the investment turnover went up compared to 1.6, now it's 1.76. So Data Link should give priority to expanding operations in the Northern Division because it earns the highest return on investment, 20 cents on each dollar invested, which is 20%. A disadvantage of the return on investment as a performance measure is that it may lead divisional managers to reject new investments that could be profitable for the company as a whole. And when would this happen? If it doesn't reach, if this additional investment is not going to reach the return on investment that's already existing, which is the 20%. So let's assume that Data Link has the following returns on investment for the Northern Division. The current return on investment is 20%, which is great. The minimum acceptable return on investment set by top management is 10%. The expected return on investment for the new project is 14%. So if you think about the Northern Division manager now, if they have this new investment project that's going to be 14%, that's going to reduce their total return on investment from 20. It's going to take it down, not to 14, but it's going to have an impact on reducing it. It's still above the minimum acceptable by the top management, which is the 10%, but maybe the Northern Division manager might think, you know what, I don't want to do this project because it's below what I already have now. So the division manager might decide to reject the project even though the new project expected return on investment of 14% exceeds the Data Link's minimum acceptable return on investment of 10%. And if you put yourself in their shoes, I'm already making 20%, I'm going to add this new project that makes 14%, that would dilute my return on investment, maybe take it down to 18 or 17, depending on the size of this new investment. So people or a manager might be reluctant to do that. So another measure that might be better than return on investment is the residual income. It's not better, but maybe motivating in some situations to the division managers to accept new projects. So residual income is useful in overcoming some of the disadvantages of the return on investment. So what is the residual income? It's the excess of operating income over a minimum acceptable operating income. So we'll see here on the next slide, Exhibit 7 here, how we calculate the residual income. It's basically the operating income. We get how much we're getting in operating income, and we subtract the minimum acceptable operating income as a percent of invested assets. So we set like a specific amount that we want to exceed, and it's a dollar value, it's a dollar amount. So the residual income would be the difference between the operating income and the minimum acceptable operating income. So if we go back here, the minimum acceptable operating income is computed by multiplying the company minimum return on investment, which in our case here was 10%, by the invested assets. So the minimum rate is set by top management based on such factors as the cost of financing. So let's go back to our example. Assume that Data Link Incorporated has established 10% as the minimum acceptable return on investment for divisional assets. So how we can calculate the residual income for the three divisions. So in Exhibit 8 here, we can get the residual income for the company's three divisions. So here we have the operating income for Northern Division, 70,000, Central Division, 84, and Southern Division, 75. And then we get the amount of invested assets multiplied by the 10%, which is the minimum acceptable rate. And that will give us 35,000 for the Northern Division, 70,000 for the Central, and 50,000 for the Southern. If we get the difference between operating income and the minimum acceptable operating income, that would give us the residual income to be 35,000 for the Northern Division, 14,000 for the Central Division, and 25,000 for the Southern Division. Still, the Northern Division is the most profitable. So, the major advantage of residual income as a performance measure is that it considers the minimum acceptable return on investment, the invested assets, and the operating income for each division. So this provides an incentive to accept any project that is expected to have a return on investment in excess of the minimum. Because you're not looking at percentage now, you're looking at dollar values. And when you're looking at dollar values, that might motivate the division manager to accept this project. So again, let's go back to the numbers and try to apply it. So the Northern Division of data link has the following returns on investment. The current return is 20%, the minimum acceptable return on investment set by top management is 10%, and the expected return on investment for the new project is 14%. So if the manager of Northern Division is evaluated using the residual income, the new project would probably be accepted because it will increase the Northern Division residual income, because it's above the 10% minimum acceptable return. So in this case, if we convert it to dollar values, most probably it's going to be more than the dollar value for the minimum acceptable return. Alright, so now let's do another knowledge check and see if we can retain some knowledge here. So the excess of operating income over a minimum acceptable operating income is known as what? Is it the return on investment? No. Is it the DuPont formula? No, the DuPont formula is when we break down the return on investment into the profit margin and the investment turnover. Is it the residual income? Yes, I think that's the right definition here. And just to confirm, the net operating income is something that we didn't, that's not related to this definition. So the right answer is C. So residual income is the excess of operating income over a minimum acceptable operating income. Residual income is useful in overcoming some of the disadvantages of the return on investment. Alright, so let me stop here. In the next video we're going to be talking about transfer pricing.